It's fair to say that most of us at some point in our lives will need to take out a loan from a financial institution such as a bank. Loans can be needed for any number of reasons. For example, student loans to fund your formal education, business loans to fund the startup of a new venture or to expand an existing one, or home loans used to purchase residential property. Whatever the circumstances may be, your goal should be to first secure the loan and second, secure the loan at a favorable interest rate. But before you go applying for loans from the bank, it's important that you first understand how the bank themselves analyze the different loan applications that they receive from both individuals and businesses. This is important to understand because having that understanding will allow you to tailor both your financial circumstances and the loan application itself to be more in line in what the bank is looking for in a favorable borrower. How's it going, everyone? My name is Dan, but you can call me Malone, and today we're going to be having a theoretical discussion around loans. We're not going to be necessarily discussing the mathematical side of loans, but more so we're going to be talking about what exactly the bank looks for in a potential borrower seeking either a personal loan or a business loan. But before we begin, as always, if I could ask you to please drop a like on the video, it really does help me out a lot as YouTube pushes the video to bigger audiences based on the number of likes that the video gets. And if you are new around here, please do consider hitting that red subscribe button below and turning on the bell for video notifications. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. So I want to start off by having a bit of a general discussion around banks and the issuance of loans. Banks are businesses at the end of the day, and profitability is obviously a key objective of any business. So the last thing that any bank wants to do is to give out loans that will end up defaulting, meaning that the borrower is unable to meet his or her loan repayments. And ever since the financial crisis of 2007 and 2008, banks have come under a lot more scrutiny when it comes to the loans that they make, as well as their overall solvency as a financial institution. For example, one of the ways in which the financial landscape of banks altered in the aftermath of the financial crisis was the significant changes made to the financial reporting requirements from an accounting standpoint that banks are required to follow. These changes effectively forced the banks to be more transparent with how they report their financial position in their financial statements, and also required them to more actively monitor and report expected losses arising from defaulting loans. This additional pressure has resulted in most lending financial institutions performing a credit analysis on prospective borrowers. The goal of this analysis is ultimately to lessen the risk of lending to an individual or business who may default on the loan. The analysis which the bank performs is typically underpinned by what's known as the 5 canons of lending, or the 5 C's. These 5 canons are effectively what I want to focus on in this video so that you gain a better understanding of how exactly and on what basis banks assess any given loan application and whether or not that application should be considered. What I want you to remember, irrespective of anything else that is said in this video, is that the banks want to know the answer to one question and one question only: are you going to pay us back? By keeping this question in mind, you'll start to realize that the obligation is on the borrower to prove, in the context of the 5 canons of lending, that he or she has the ability to pay the loan back. So the first canon of lending that I want to discuss is character. Character is probably the most important canon out of the 5, even though it's also the least quantifiable. Character in the context of lending refers to the borrower's ability to demonstrate both integrity and trustworthiness as an individual. It's the part of the lending decision that's focused on you and you alone, and it's therefore a very individualistic aspect of lending which will vary greatly on a case-by-case basis. The reason why the bank's perception of your character is so important is because the banks will typically want to lend to an individual or business who can demonstrate their quality as a borrower. For example, some of the traits that will help validate a prospective borrower's character are a strong credit history, aka past evidence of your ability to meet loan repayments, employment history, aka the stability of your employment status, or formal education, the extent of the borrower's educational background. The good thing about character is that you personally have control over it. Let's say you have no proven credit history because you've never had a loan with the bank. Well, one example of how you could actively start building one is to get a low limit credit card and use it to pay for some of your day-to-day expenses and simply just meet your repayments on time. The more that you can prove to the bank that you're a trustworthy individual to whom they should lend money to, the more likely they are to make the loan at a reasonable cost. The second canon is capacity. Capacity refers to the borrower's ability to meet loan repayments using the cash that that individual earns from his or her employment. In the context of a business loan, capacity refers to the business's ability to meet the loan repayments using its cash flow from operations, aka the cash that it earns from whatever business it may be engaged in. The terms of the loan will impact the level of repayment capacity that the bank would expect to see in the prospective borrower. borrower. For example, loans which are repaid over longer time periods are riskier for the banks to execute because there's a greater chance of default. Therefore, a bank would expect a greater or more consistent loan capacity for loans with longer repayment terms. For individuals, the bank will be looking for information on your employment, your salary, your income relative to your expenses, and any other outstanding loans or debts that you may have with other entities. Effectively, what the bank wants to know is this: will the borrower be able to pay back the loan considering all the facts and circumstances around their past, present, and likely future income and expenses? For businesses, the bank will likely request the past financial results of the business in order to make an assessment around capacity. The bank will likely have a predetermined method for quantifying capacity, usually by expressing your total existing debt as a percentage of income, aka what percentage of your monthly income is already tied up in other financial commitments. The less available cash the borrower has, the more likely he or she is to default. The third canon is capital. Capital refers to the borrower's existing resources. This can include the likes of fixed assets such as property, or monetary assets such as savings accounts, personal investment portfolios, and life assurance policies. The more capital assets an individual has, the more likely they are to secure a loan from the bank. This is because the bank is effectively being shown evidence of additional ways in which the individual can meet their loan repayments. For example, if the individual experiences an interruption in their regular income stream, or if the individual's income stream simply becomes insufficient in terms of meeting the loan repayments. As regular viewers of the channel will know by now, I'm a big proponent of investment and saving strategies. And this is yet another example of why investing and saving money is so important. Not only are you demonstrating to the bank that you have a capital sum set aside, but you're also demonstrating that you're taking active steps in improving your financial well-being. The bank is only delighted to see a borrower take an interest in their own personal financial independence. And the reason for this is because it only further validates the bank's determination of the borrower's character. From the perspective of a business, the bank will be interested in other factors such as the value of the loan that the business is looking for relative to the total assets of the business. The more interest that the owners have in the business, aka owner's equity, the more likely the bank is to approve the loan. This is because the business has more incentive to repay the loan, because if they don't, the bank will likely be able to claim its assets. The fourth canon is collateral. To provide some context for this canon, loans can be either secured loans or unsecured loans. Secured loans are loans which are made by the bank to a borrower where the loan is secured by an asset as collateral. What this means is that if the borrower defaults on the loan, the bank can claim the asset pledged as collateral on the loan. The most typical example of this form of loan arrangement is a mortgage. A mortgage is a loan taken out for the purpose of purchasing property. The mortgage is secured against the value of the property until the loan is repaid, meaning that the bank can claim the property if the borrower defaults on the loan repayments. The fact of the matter is that the bank is always going to look more favorably on an application for a secured loan, because the bank is gaining that extra layer of security in the event of non-repayment by the borrower. With an unsecured loan, on the other hand, the bank is solely relying on the income capacity and available capital of the borrower in order to repay the loan, which bears an additional degree of risk that the bank may not want to take on. The fifth and final canon is conditions. This canon refers to the actual terms or conditions of the loan arrangement. There are lots of both macro and microeconomic circumstances which will impact on the terms of any given loan arrangement. For example, the prevailing interest rate at any given time will invariably impact the interest rate offered on loans to both individual and corporate entities. The prevailing rate is the minimum interest rate that lenders would expect to receive on their financial assets, and so fluctuations in this rate result in fluctuations both positive and negative in the interest rates offered on loans. The potential impact of current economic conditions on the borrower are also considered under this canon. For example, in times of economic uncertainty, the bank might exercise greater conservatism in its consideration of a particular loan application. This could apply in the case of an individual who is employed in an industry which, in the current economic climate, is considered to be unstable long term. Or in the case of a business, future projected revenues may be questioned to a greater extent by the bank if the business's industry of operation is impacted or likely to be impacted by any degree of uncertainty. The events of 2020 are a case in point example of the sort of economic uncertainty that will directly impact the conditions of loans for both individuals and businesses. So hopefully, having discussed the 5 canons of lending, you now have a greater understanding of the thought process that goes into the lending decision by the bank. By understanding what exactly the bank is looking for in a loan application, you better your chances of not only securing the loan, but also securing the loan at a favorable interest rate. As I mentioned earlier, by taking active steps to improving the bank's perception of your character, as well as having a pool of capital available in the form of both investments and personal savings, you really are showing the bank that you're a financially educated and trustworthy individual to whom they should lend. There are of course other considerations that the bank will take on board when reviewing a loan application. For example, in the context of business loans, the bank will have to consider what's known as their credit risk appetite statement. This is effectively a predetermined level of risk that the bank is willing to take on and is imposed through lending limits on certain sectors. For example, if the bank was to lend exclusively to businesses operating within the retail sector, the bank will be subjecting itself to all of the risks associated with that industry. So by imposing lending limits on certain sectors, the bank ensures that its loan portfolio is well diversified, and this effectively reduces the potential impact of an industry performing poorly on the loan book of the bank. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.